Hello, everyone, and welcome to Money Matters TV. I'm your host, Ken Jordan with Princeton Mortgage, and I am joined today with my guest host, Fred Lahm from Princeton Mortgage. Fred, how are you, my man?
Man, I'm doing great. Yourself?
I am doing well. So Fred, we being in the mortgage business, there's never a dull moment. Things are always happening, and not always what you'd expect. So let's give the viewers a little sense of what's going on in the mortgage market these days.
Yeah, it is definitely not what you think it is. You know, one day it's one thing, and the next day it's something else. Especially with the bouncing around the interest rates and the payments. So it's always good to be in touch with somebody that's in the know. That's why it's important right now to be in touch with your agents on a daily or weekly basis, and your loan officer if you're going forward, so that you know those trends.
Fred, do you think it's interesting? Mortgage Bankers Association, Freddie Mac, Fannie Mae, National Association of Realtors, all had interest rates kind of predicted to have been lower than they are right now. I think a lot of those bodies had mortgage rates predicted to be in the mid fives, and of course, that's not what we're seeing. How do you think that's impacting volume? And do you think that the interest rates are still messing with people's heads?
Yeah, I think it's definitely impacting volume because there's not enough inventory out there. You know, I mean, we want to be pushy as lenders and loan originators to say, who cares about the interest rate? But the fact is, you have a house that you bought a couple of years ago at a 3% interest rate. Where are you going right now? If you're looking to downsize, it's going to be tough because that rate's going to be 7.5%. So it doesn't really financially make sense to go ahead and downsize. So inventory is low. Those people are not selling right now. So it definitely has an effect on, people's pipelines. Isn't that what you're seeing out there, Ken?
I am. I will say that I think that what we're experiencing a little bit of is a little sense of calmness. That doesn't mean that rates are where we want them to be, but I think, maybe you would agree that because we're not seeing massive spikes, the jumps and the dips that we've seen, maybe over the last 12 to 18 months, I think there is almost a realization that this is where rates are. And buyers are starting to decide, okay, I'm going to enter the market. The people who are saying I'm waiting for rates to come down, I don't know that that's necessarily the conversation that's being had right now. I think that the people that want to buy have come to terms with where rates are right now and are willing to enter the market as buyers. Now, that certainly doesn't do anything for our inventory problem, does it?
No, but I think the more education that you have out there, talking to professionals and getting the real deal, what's on the streets, is where you're going to win. For instance, people are concerned about the interest rates, right? Payments. And in my experiences, I had some conversations and trainings this week about that. The real problem isn't the interest rates. In the scheme of things, I know we want to say, 1982 rates were 18%, and we can go back and forth about the house price back then. But the median income around back then, 1,000 a year, 19,000 a year. So it definitely matches up. But the real problem here is home prices, and I'm not complaining about that. I'm just, you take a $300,000 home at 3% interest rate and bump that up to 7%. Okay, you're looking at a little bit of increase, and you can deal with that considering that we spend money mostly on things that probably cost that same amount every month that we could do without. The problem is you go from 3% to 7%, but then also add $200,000, $250,000, $300,000 in value. That's where the real issue is. So the more we educate and break it down apples to apples rather than apples to oranges, is where you're really going to see growth in your clients to hang on tight and come back to you when they're ready to buy.
Yeah, without a doubt. Let's shift gears for a minute. We talk about home buyers, and whether it be first-time buyers or second-time buyers, but the primary residence is the focus of a lot of the conversation. But there's some pretty good opportunities out there for investors. We have the what are called non. Can you describe for our viewers what is the non-QM loan, and what are some examples of non-QM loans?
Non-QM loans are those loans that the old days they called subprime, right? And everybody got out of subprime loans with lower FICO scores or products that really Fannie, Freddie, and our government really doesn't want to back or secure. And those have now they're called non-qualified loans, non-qualified mortgages. And they're your specialty products right now. For instance, one is called a DSCR loan, debt service loan. Um,
Tell us about that.
you've heard about this, right, Ken?
Yeah, yeah. Tell us what is debt CR? What DSCR? What is that? What is that? What kind of a
Well,
loan is that? How does it help people?
this is probably my second favorite mortgage product aside from the renovation loan product, but this is essentially utilizing the income on the property projected investment home as your qualifying income, and that's it. You have credit report as long as your FICO score is above a certain amount, as long as you have the assets in an account that can be verified for 60 days. And you can show through an appraisal or rent schedules or any leases that that mortgage payment is going to be at or below the potential rent. You're done. You're qualified. No questions asked. There's no income credit. I'm sorry. There is no income verification. Okay. There's no tax returns needed, and it's a very, very simple process. I close one in 6 days because they are very streamlined, and it's the ability to really take your hands away from any kind of risk and let the house work for you.
So debt. So DSCR stands for debt service coverage ratio, and it's available for people who are not own. They're not going to live in the property. They're going to rent the house out, and they can essentially qualify on the rents. What are some other non-QM products that you're seeing out there?
I mean, for one, I don't really run into any, non Cuban, but these bank statement loans sometimes help. Sometimes people have a job out there that is up and down with income, self-employed, your carpenters, your builders that potentially are good 1 month and lack the other month. And you show 12 or 24 months of bank statements that could show continual growth or maintain a certain amount of money coming in over a 12 or 24 month period. You can utilize that to qualify for a loan. And what happens with these non-QM is that these banks and investors that are putting their money on the line, you're playing with their rules. So in some ways it's easier, in some ways it's harder, and unfortunately that's where it is right now if you want those specialty loans. But for the right person, they work. I mean, what have you been seeing out there, Ken? Have you been closing any non-QM loans recently?
A handful, and you're right, they are helpful. I mean,
Yeah.
if you're not going to be living in the property, it's an extremely helpful, alternative way to document ability to repay. And I think at the end of the day, that's really what everyone is after. Can this person repay? And I'll add to that what separates these products from what you call the subprime products from 2001 through 2008 is that there was no focus on the borrower's ability to repay. All right.
Right.
It was strictly, credit score driven or asset driven, which is only one part of the equation, right? They have to be able to show they've been able to manage debt. They have to be able to show that the assets they're contributing are their own, and they have to be able to show that they have the ability to repay these debts. And I think the non-QM has gotten a creative way to show ability to repay, and that's why I think they're different than what the subprime loans were of 2000 to
Yeah.
2008.
And especially for your self-employed, if you have a
Yeah.
special, and in those situations, rate typically is higher than your normal QM qualified
Mhm.
mortgage products because of risk factor. But when you break it down to your client, again, it's all about education. When you explain the risk factor and what you're doing it, or why are you taking out that loan for the business or whatever avenue you're going with, you have to look at it as inflation, quote unquote, right? Inflation we're all dealing with is just part of the business. Just like if you're a contractor and those lumber prices go up. It is what it is. As long as it fits into your mold, and in the future it's going to benefit your business. It's just part of the game.
So we're going to switch back. I have a question here, a viewer question, Fred, for you. The question of the day is from Gary Franks. The question of the day is from Jack Young from Philadelphia. Why should I get pre-approved for a mortgage? Fred, why should someone get pre-approved for a mortgage?
This sounds so simple, but really it is complicated because of especially the way the industry is right now. There's a lot of people out there that have hearsay. People from work, and they got qualified and they took out a certain interest rate 2 years ago, or they qualified because of this. It's very important to go ahead and see where you're at, even if it's a year from now you're looking to purchase, because I'd hate to have your dream shattered when you finally do find the one, especially in this market where it's really tough, and you find out that, like, oh, I can't afford it, or oh, I didn't know that I could just report to the government that I write everything off of my tax returns and I actually pay tax on nothing. I had no idea. And so it's better to see where you're at right now. Um, the big turn negatively to that is, well, you're going to hurt my credit, and that's a misbelief. And I fight with people all the time about that. A credit is simply a snapshot of what your credit is currently. And so if you're worried about your credit scores dropping because you're having a mortgage inquiry, you shouldn't, because it's something that's low on a totem pole, and you need to see it, and we need to see it, and you'll feel better if you know where you stand. Even if you think that you're 100%, you never know. There's always something that might sneak up on you.
There's a lot to it. I agree. Well, here's how to get your question answered on Money Matters.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
So today we are joined by our guest. Our guest is Joseph Lomanno from Berger Communities. And Joe, I can't think of a better conversation to have you on board with than the one that me and Fred were just having, because there's the flip side of purchasing a home, obviously, is renting, and you can hopefully give us kind of a sense of what's going on in the marketplace today. So why don't we start, Joe, with why don't you tell us a little bit about what you're seeing in the multifamily space?
Oh, thanks for having us on, Fred and Ken. Appreciate it. I would say it's similar to what you're seeing in the single family, right? Low inventory for the last few years. Now, luckily, what we've done is a lot of people responded to that by building, right? So we're starting to see a little bit of an increase in inventory, and rents aren't rising as much. We would say they're decelerating, right? They're still going up, but when you look at, I guess, right after the pandemic, you were seeing increases in the 10 to 15, even 20% range, right? Annual increases. Now they're back to a more healthy 3 to 4% increases, which is better. It's better for the industry, better for the renters as well.
So talk about so what you're telling us is that while rents are still going up, we're not seeing the same kind of the same level of rent increases that we saw kind of during and post pandemic.
Exactly. Yeah. So, I mean, like I said, there's still people are, I guess during the pandemic, people weren't going anywhere. There wasn't anywhere to go, right? They were locked into where they were because there weren't many options. Now that there's a little more options, people are being a little bit more selective. So they're coming back to what I would call a healthy place.
So with regard to supply, you're seeing more construction in that area?
Yeah, we're seeing more construction. It's slowed a bit. I think, after 2008, people are hesitant to keep building, right? But the buildings that were taking a long time to build because of the shortages and labor issues during the pandemic, they're now coming to completion. So we have a lot more coming on the market.
Let me ask you about renters. What is it that renters are looking for right now?
So the name of the game, I mean, it's really about customer service, right? They want ease of transaction. They want to be able to search easily. They want to be able to apply easily, tour easily, right? Having multiple touring options, kind of being a one-stop shop. And flexibility is really also the second thing that they're really, or probably even the first thing they're looking for, right? This day and age now where, we're in a technology / AI driven society that we're in, people want what they want when they want it, right? So just by being able to be flexible with your resident, right? By offering different flexibilities for this, for whether it be flexibilities as far as concessions on rent or being able to break a lease at certain times, or allowing pets, different flexibilities, workspaces, right? Outdoor spaces, all these different flexibilities, giving them options is really what they're looking for. And again, the technology that we have that's coming to this industry has really enabled us to be able to offer that more to our residents.
So it sounds like amenities, flexibility, these things are all important, to the renter. What are the property management companies doing to differentiate? What are some specific things that some property managers are going to really separate themselves from the pack?
So that's a great question. I would say that again, meeting people where they are. Some things that they're doing is, so I know for us, for example, at Berger, we have a great transfer flexibility where we allow our residents to transfer from one place to another, from a different size unit to another, from one community to another, right? And then a big one that we really like, that we've seen a lot of success with is, and we're starting to see other people do, is we allow people to break their lease when they buy a home. It sounds counterintuitive to just let them leave whenever, but at the same time, having this flexibility enables us to attract so many more renters, right? And it helps them stay longer because they have that flexibility, right? Perfect example, talking to a resident the other day, they said to me, I sold my house 3 years ago and hope to find it in, the time that I was under contract, but never was able to. So I found one of your communities there, and I leased there because I knew you had this flexibility. And here we are 3 years later, I'm still looking for a home. And now they're on their way though, right? But because they had the flexibility, right, that's why they chose it, right? And I feel like the industry as a whole historically has kind of been reactive rather than proactive, right? Kind of late to embrace new ideas, right? What they've been doing for a long time seems to work, so why bother trying to fix it? Well, this is why, right? The society is changing. People are changing. So to be able to offer these things are really powerful tools to be able to attract more people, more renters that ultimately will stay longer.
I read one of the other things that communities are doing, and it's interesting. It's interesting that a rental community is going to help someone become a homeowner. Right? It's counterintuitive, like you said.
Yeah.
But one of the things is rent reporting. Can you tell us a little bit about what that means and how it plays out in the marketplace?
Yeah, it's another great question. So, you look at the biggest expense for a renter is going to be their housing, right? And they pay their credit card on time, that gets reported. Make their car payments on time, that gets reported. But their largest expense by far, paying their rent, never gets reported, never has been reported. So we're starting to see some more companies out there that are offering different programs that actually enable property management companies to be able to report on-time rent payments to the credit unions, right, to the credit companies. So, and they also offer different flexible payment options as well. So there's some companies out there that allow you to say, split your monthly rent into two separate payments throughout the month, right? And the best part about that is you're making sure the property management companies getting paid on time, but you have until say the middle of the month to pay them back, right? Increases your cash flow. At the same time, they're reporting those on-time payments to the credit companies. So it's a great option for them. And that's just one example of the industry being innovative and again, trying to help people. And from what I understand too, Ken, you may be able to speak a little bit more to this, is that I think Fannie and Freddie have actually embraced this, right? Where they're actually factoring in on-time rent payments and looking at mortgage approvals. Is that true?
Fred, you want to take that? What are you seeing out there with regard to the rent payments and how it's impacting approvals?
Joe, that was great because I was going to bring that up, and there is credit ability to give credit where credit is due now. So for somebody that doesn't have any mortgage reporting history, we have now a box, and Fannie Freddie will consider that Now, obviously, as you go through underwriting, you'll have to prove it. We'll have to reach out and then get some sort of verification of rent, VOR. But yeah, it could be this scenario where you have somebody that's maybe doesn't have a ton of assets, maybe has a little bit of debt load, maybe a couple lates here and there on credit cards that are minor, but has maintained month after month that big nut, that big payment that is the most important, that's on time, will then give the approval and allow them to get into a house and take advantage of a lot of first-time homebuyer programs out there as well.
Joe, you had mentioned the term, or I'd seen a term, dual shopper. What is that? What is a dual shopper, and what does that mean?
So Zillow releases a housing trends report every year. It's kind of, I don't know if it's a term they coined, but what they found was, I think it was somewhere around 65% of renters actually considered buying a home when searching for a home to rent, right? So especially when it comes to millennials, I think that number is almost up to like 80%. And so they're dual shoppers. They're shopping for both an apartment and a home. Now, as you guys were discussing earlier, the big obstacle for them buying a home is inventory and affordability, right? So they go back to being, a renter, right? They're shopping for both. They would consider buying if they could find something, but until they can, they rent. And again, that's where that flexibility to be able to attract someone that is that dual shopper comes in. That's where it's a powerful tool, and it can be a real differentiator for property management companies like us to be able to attract more renters, because they're ultimately, we understand, right? Like, renters always have, always will buy homes, right? No matter how much we want them to come and stay with us forever, it's inevitable they're going to buy homes, right? So we said, okay, what are we going to do about this? What can we do about this, right? We embraced it. And I go back to my early years as a real estate agent with Keller Williams. They're big on win-win situations, right? Looking for a win-win. And I feel like when companies start offering these kind of flexibilities, it really truly is a win-win, right? It's a win for them because it's a win for us as the property management company, because we're able to attract and retain more residents, right? It's a win for the residents because they have the flexibility to be able to do what they want when they want.
I think it's interesting because when you think about there's people who are first time buyers, and then there's also people who have a house to sell. And Fred, I think you'll agree that one of the most challenging things about getting your offer accepted in this market is what they call a home sale contingency, right? Where in order for us to buy this house, we have to first sell and settle on the house that we own. Joe, tell us about how that flexibility impacts your negotiation when it comes to the home sale contingency and where you see that strategically.
Yeah, so the home sale contingency is, it's a tricky one, right? As an agent, I know I never like seeing that on an offer, right? So to be able to remove that from an offer, offering a solution, whether you're a seller looking for short-term housing, stop by here and you can live here until you find that place. Whether you're a first-time buyer, right? Same thing. Take your time looking for it. You don't have to have a contingency. Like I said, I tell a lot of local agents that I know, you have empty nesters out there that don't want to, may want to sell, right? They have this big house that they, raised their family in, and now they don't really need it anymore. And they would love to sell their house, but where are they going to go, right? They can sell their house, take advantage of the great market, right? And then rent an apartment and find a home at their own pace, right? They don't have to worry about having a home sale contingency because they already sold their home, right? So that's a great advantage of it.
And your lease is not always lined up with the best time to buy. And maybe some people feel that pressure, like they buy something that maybe they shouldn't have because they had this like really intense, pressure, this window, and they had to make a decision, and that flexibility kind of moves them away from that. I really like that the rental community industry is kind of moving in that direction, and I think it definitely dovetails into what we do, and I think that's pretty cool. So So give us, what's the overall outlook for you guys over the next couple of years? What are you projecting?
So we're projecting to see a lot of the same, right? Rents, occupancy is at a good place right now. We're at around 95%, which is where we want to be. You don't want it too high. It means our rents are too low. You don't want it too low, either, obviously, for obvious reasons, right? But we anticipate it to maintain, right? The building has slowed down. Luckily, wages to an extent have kept up with, recently, when I say, keeping up, I'm talking about over the last couple of years, wages have kept up with rent increases. So, the affordability as far as rent isn't going to be as taxing as it is for first-time buyers that are looking at single-family homes.
And I think the other thing to keep in mind is that, while the jobs reports, may or may not tell the whole story. Well, how many of these jobs were added were part-time? How many of these jobs, were lost or underreported? I think that all in all, unemployment has been relatively stable. And I think that lends itself to, decent, steady increases. And I think that if anything is going to change, if we start to see a shift in the unemployment market in a meaningful way, then certainly that could impact not only house prices, but also rentals. Is that fair to say?
Yeah, I'd say so. I say so.
All right. Well, Joe, we appreciate you joining us today. This was awesome. This was great information. Hope to have you back again. In the meantime, please join us next time where we will have Gary Franks, president of Eagle View Services, a sports equipment company. Until then, this is Money Matters TV, where your money matters.